Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hi there, welcome to the COB. I am Nadine Blaney and it is the 18th of June. Lovely to be here with you once again. If you're watching us live on demand or listening to the podcast, we're really happy that you're here. Now, let's talk about this market, shall we? Because we had a short time in positive territory. Things were looking pretty good in the 10 o'clock hour. We had other markets around the region coming online, hitting record highs. And then we just decided to really go our own way. So losing ground, by the time I was on air at noon, we were well into negative territory, and it looks as if that's where we'll finish the day. The CBO Australia index is on your screen right there. The S&P ASX 200 is also in the doldrums, and that was despite US futures looking pretty punchy, higher throughout the day today. Look, we did have European futures coming online looking mildly negative. I'll get you across all you need to know in just a tick, but one thing that we should point out is that we continue to see oil prices fall. So let's call it a crude awakening. Oil prices retreating as it looks as if we have had signatures put to paper on that peace deal between the United States and Iran, although the US President Donald Trump does say that he could continue to bomb if we don't see any, likewise movements towards peace and the Strait of Hormuz opening in Iran. Look, the banks were a bit of a problem. They were the problem child for this local market today. And that sector really did help weigh on markets overall here locally. And hawkish hold. So I think by now you know that we heard from the US Fed, Warsh, it's a new era. I was speaking with Ronnie Green a little bit earlier today. The interview's up online, but he said that Warsh was really keen, the new chair of the Fed, to put his mark on things. He said there's a new sheriff in town, but you know, he reckons, as did Stephen Miller from GSFM, that what he was saying did make sense, and there is a hawkish hold in place. And don't forget, we have the Bank of England tonight. Stephen Miller, aforementioned, also said that he expects to see potentially a hawkish hold coming from the BOE as well. All right, I mentioned the banks. Here we go. When you've got CBA down by 0.5%, Westpac and NAB, sometimes it's hard to get a lot of momentum. So the financials was one of the worst performing sectors, but you know, look no further, of course, than some of these gold miners. They did weigh on the market as well. Evolution down by about 2%. But again, we've seen some really big gains once we saw peace in the Middle East being a more reasonable prospect. And information technology, infotech, the worst performing sector, in fact. WiseTech off by 3.5%, Xero down by 4.3%. Hey, if you like tech and you like international tech, we did have an international special today on the call. A lot of tech talk, and our stock of the day, very related to that thematic. I think we should mention energy. Energy as a whole off by about 1%. In news, nickel industries did slip, down by close to 4%. Jefferies is flagging Indonesian regulatory risks, which could potentially see more nickel sold on the market. Sol Pattinson hit a record high, though, of $1.33 billion as it divests some Brickworks assets. Cube Holdings getting the green light from the ACCC for its acquisition by Rubik Australia. Challenger, well, shares doing well today on the merger of its funds management business with investment solutions firm Channel Capital. Paul Warren, who is the son of founder Peter, has acquired $4.4 million worth of shares, and Peter Warren Automotive like to see that type of inside buying. Well, this doesn't happen very often. In fact, I'm not sure it's happened before. Isaac Poole is joining us on the COB from Ascalon Capital. Hey, Isaac, lovely of you to join us today. Can you tell us what you make of the move that we saw in terms of, you know, this new era being put in place at the Fed under Warsh?
It was an interesting result, really. I guess what we saw there was far less communication from the Fed in their statement after the meeting. And that sounds or looks likely to be the case going forward for this new era under Fed Chair Warsh. What was communicated was relatively hawkish. I think the focus in on getting inflation stability over the labour market mandate that the Fed has was interesting to note, as was the dot plots, where around half of the members saw the risk of a hike this year. And of course, we had one conspicuous dot missing from Fed Chair Warsh. And again, that probably points to the fact that these dots are going to change over time. We won't have them represented in the same way every quarter that we do now, and that means markets are going to have to get used to a different type of communication style.
Yeah, announced 5 working sort of task forces that will be overhauling the central bank operations. So that does very much speak to, can we call it a minimalist Fed, Fed light?
I think that's going to be the case in terms of communication. There will be less for markets to really focus in on, and that can be a challenge sometimes for investors. But on the other hand, it perhaps allows markets to get back to focusing on the real economy rather than trying to guess what the Fed's reaction will be to that real economic news. And that may be a good development, but for now, I think we're sitting in a world where the Fed at least is trying to indicate that it's going to leave policy relatively unchanged unless it's dragged towards a rate hike. But there will be a lot more guesswork involved in that for markets going forward.
Mm-hmm. Okay, so we've got some data in the UK coming out. Job vacancies, 707,000 in the 3 months to May. I'm not going to ask you about that, but we did have an inflation read in the UK that came in slightly weaker than had been expected. I think it was 2.8 versus 3. Are we expecting this sort of, guest earlier called it this sort of trend, this global trend of hawkish holds coming through?
Yes. I think the challenge central banks around the world are facing is that inflation has impacted most parts of the world universally, but the growth impact has been quite different. And the UK is a good example of this, where inflation is above where they would like to be, although a little lower than consensus expected this month. But growth is being impacted, and I think that's part of the reason inflation came in where it did. So central banks have to manage this. They would like to support the economy, but they also don't want inflation to get out of hand. So hawkish holds are perhaps going to be more common. I think the hurdle for central banks to hike, or many central banks to hike at the moment, is elevated. That's true in Europe going forward. I think it's true here in Australia, and also true in the US, where there's a little bit of tough talk there. But overall, I suspect interest rates or policy rates across the developed world would look very similar to what they look like now at the end of this year.
Okay, so we're obviously always interested in, what's going on in terms of central bank speak. But when we are looking at different asset classes, I can't help but notice that this US-Iran deal has sparked, record highs for Asian markets today. Not so much our own. I mean, we're very much lagging. I suppose that's a reflection of us being heavily a commodity and banks-led market. Do you have any interest in Australian equities? Where would you be putting your sort of equity exposure now?
I think that Australia faces some challenges, some real headwinds from what I would say is underwhelming growth outlook, and a central bank that is going to be forced to be a little bit more hawkish than I think they would otherwise like. And as you mentioned, some concentration in sectors that are probably going to face a little bit of a headwind going forward. So yes, we have exposure to Australian equities, but we're very cautiously positioned up in quality and low in beta, if you like, to our neutrals. Looking around the world, the US does still stand out a little bit as an economy that's really performing better than we had anticipated, better than a lot of its developed market peers. But the challenge is valuations are so stretched that you really need to get solid earnings growth to justify them. So again, we're exposed, or we have positions with the US, but not a great deal. where we've found some value is in emerging markets, and specifically Asia. Over the last 6 or so months, relative valuations looked very good. There were some challenges from higher oil prices and growth, but more broadly, we saw it as a place where there was still some material upside from the AI story and the tech story, and those valuations just felt like a better place to be.
Oh, wait. Okay. So from here, when you think about asset allocation for the remainder of the year, I know that's a big question, but if we do have peace in the Middle East holding, we do have the Strait of Hormuz, remaining open, and we start to see the flow of goods and, importantly, oil through that strait. How does it make the rest of the year look to you, Isaac?
I would position this as a year that looks really great for diversified portfolios. So if you think about a sort of traditional 60-40, in that 40% bucket of income or fixed income or defensive assets, you're getting yields that there would be a whole host of people out there who have never experienced yields this high in their working career. Sort of multi-decade highs in Australian government bonds, in US treasuries, in other developed market government bonds. And that means the all-in yield for really high quality credit is also pretty attractive. And that hasn't been the case for several years. So for us, remaining well exposed to that fixed income side, being thoughtful about getting yield and downside protection is really important. But in the equity side, again, we see that returns look pretty good and are likely to be okay this year. But we prefer not to be too concentrated in some of those mega cap names. Again, getting some diversification across Asia, being diversified in developed markets, and being selectively underweight to places that look less good like Australia. We think that's going to end up delivering some really decent returns for investors this year.
Okay. Look, Isaac, it's been great to have you join us at the end of this session. Anything you'd like to leave us with, that we haven't covered, I think, that you think is really important for investors? Putting you on the spot now.
Yeah, no, I guess I would leave with some caution around the market pricing movements that you're seeing in interest rate expectations at the moment. I think there was a knee-jerk reaction to expecting rate hikes in the US, and we've seen that in Australia. Central banks are far more cautious than that. I think right now is a good opportunity to pick up yield in government bonds and get some potentially really solid capital gains over the next 6 months.
All right. Isaac, I hope you have a great night there in Tasmania. We'll see you soon.
Thanks very much,
Take
Nadine.
care. Isaac Poole there from Ascalon Capital. All right, I said that we are going to stick with an international view, and that included the stock of the day, which was SK Hynix. So it hit a record high today. It is, sending product and working with NVIDIA. So I asked our experts, Mark Gardner from MPC Markets and Mark Moreland from Value 3, what they think.
The numbers are pretty compelling. 72% operating margin. It's got 70% of NVIDIA's HBM memory orders. Q2 operating profit year on year was up like nearly 600%. But I mean, look at that chart. I think it's up a couple of thousand% or so, in the last couple of years. So it is the purest play in the AI memory cycle.
But at the moment, they're bringing out an ADR apparently in the US. But there's also talk from my AI that they might dual list in the US, which will make them accessible. And if you can invest in it, I think it's a buy because of the fact that even though it's had a big run, I think it's in a better position than Micron. And I think even though Micron's interesting as well, I agree with Mark. But if I was going to choose one, I would go for SK Hynix if I could invest in it. And the dual listing thing, or the ADR, apparently is supposed to be happening, I think, this month or next month.
Oh, okay.
All right. In the US.
All right, let's just take a pause, take a look at some of these market leaders. So got back to equities. Megaport today, one of the best performers. Mesoblast as well. 4D Medical, Deep Yellow, and A2 Milk. Now, let's get a look at some of those that did not help this market out at all. Pantoro in the gold space, Aura Banda, Seek, Waypoint REIT, and Zero. There was, a lot of selling in that tech space here locally today. In the small end of the market, Cauldron Energy did well. I'll have to find out why. Up by close to 31% to 12 cents per share. And those that were a bit of on the, losers? Bougainville Copper, a second day in a row, down 20% to 30 cents per share. Tonight, Bank of England expected to hold rates at 3.75%. We get the Conference Board leading index for the month of May, and we'll see how U.S. markets continue to digest all of the tough talk coming from the new Fed Chair Warsh. Tomorrow, Japan, we get core CPI. Of course, the BOJ lifted rates this week, and already, they are efficient. We get the meeting minutes. I think we've got to wait another, probably a week and a half to get ours from Tuesday's meeting. Not throwing shade, but just pointing out that they're very efficient over there. All right, checking in on this local market. We have the COB Australia Index, as we know, closed down by about 0.5%. Taking a look at the S&P ASX 200, steeper losses, down by 0.6% to 8,911. Still have U.S. futures looking pretty solid. Asian markets, for the most part, also outperforming. But again, we saw gold falling, we saw oil falling, we saw iron ore under $100, and you know the nature of our market. So I think that goes a long way to explain what happened, as well as, some selling amongst the big four banks. Well, that was a good day. Thank you for joining us. Really appreciate your time. We would love it if you could tell your friends about us. The more, the merrier. And I think that strength in numbers, right? If you have missed anything, catch up overnight, and we'll see you at 9:45 tomorrow.